Today, I want to consider one sum on partnership admission. I want you to observe the sum on the screen. First, I will read the sum for you. Ramesh and Naresh are partners of a partnership firm sharing profits and losses in equal proportion. The balance sheet of their firm as on 30th June 2005 is as under. Land and building, debtors as bad debt reserve, stock, cash balance and outstanding income are given on asset side. On liability side, you are given the capital account of Ramesh and Naresh, bank overdraft and creditors. On the date of balance sheet, Ramesh and Naresh admitted Pankaj as a new partner in a partnership firm on the following terms. First, Pankaj should bring 25,000 in cash against his 1/4 share in future profits. The value of goodwill is determined at ₹40,000. Look that in the balance sheet, on the asset side, we don't find goodwill. That means goodwill is not reported in the balance sheet. And the book value of goodwill is 0. Book value of goodwill is 0. And that's why it is not reported. And its valuation is made is 40,000. So book value 0 means building not reported in the balance sheet. Its valuation is made at 40,000. So there is an increase in value of goodwill 40,000. Increase in value of asset is a gain. That gain should be credited to the partner's capital account in the old profit sharing ratio. Generally, for other assets, if there is an increase in asset, we first credit that to revaluation account or profit and loss adjustment account. But in case of goodwill, we won't do that because goodwill is an intangible asset and its valuation increase or decrease when its valuation is made, increase in its value or decrease in its value, whatever it may be, is transferred to the partner's capital account in the old profit sharing ratio. Here the goodwill is not disclosed in the balance sheet, means book value of goodwill is 0. Book value of goodwill is 0. And valuation made is 40,000. So increase in value 40,000, that will be distributed in the equal proportion between Ramesh and Naresh. The value of land and building is determined at 1,20,000. Land and building 1 lakh, increase in value 20,000, credited to revaluation account or profit and loss adjustment account. Provide for 10% bad debt reserve. Debtors are 22,000, bad debt reserve required 10% means 2,200. Existing reserve is 2,000. Additional provision to be made 200. For that, revaluation account gets debited. The value of stock is to be reduced by 8,000. Decline in value of stock loss debited to revaluation account, and the reduced value of stock will be reported in the balance sheet. Outstanding bank overdraft. Outstanding interest on bank overdraft 5,000. Bank overdraft is 45,000. Outstanding interest increase in liability. That liability will be reported in the balance sheet. Interest outstanding liability will be reported in the balance sheet. Increase in liability. This is a loss. This loss is debited to revaluation account. Or say thirdly, profit and loss adjustment account. Out of the creditors, 2,000 not payable. Declining liabilities again, revaluation account credit, and the reduced value of creditors will be reported on the face of the balance sheet on the liability side. From the above information, past goodwill related necessary journal entries in prepare new balance sheet along with necessary accounts. We are going to record all the journal entries for your better understanding. Now here I prepare profit and loss adjustment account, partner's capital account, cash and bank account, balance sheet after admission. First I consider the revaluation adjustment. Value of land and building is 1,20,000. Book value 1 lakh. New value 1,20,000. So 20,000 is the increase in value. Increase in value is again credited to profit and loss adjustment account. Other name is revaluation account. Journal entry for that land and building account debit to profit and loss adjustment account credit. So here 1 lakh plus 20,000 increase, 1,20,000, 20,000 credited to profit and loss adjustment account. This is our first revaluation adjustment is taken into consideration, is taken care of. Provide 10% bad debt reserve, 22,000 into 10%. So 2,200 is the bad debt reserve required. Existing bad debt reserve is 2,000. So additional provision required is 200. Profit and loss adjustment account debit to bad debt reserve account credit, that's a journal entry. Here 22,000 minus 2,200 and 200 additional provision required debited to profit and loss adjustment account. Additional provision, and that provision decreases the value of asset and it has been debited to profit and loss adjustment account. Value of stock is to be reduced by 8,000, stock is 40,000. Decrease in value of stock is a loss, profit and loss adjustment account debit to stock account credit. Stock 40,000 minus 8,000, 32,000. Decrease in value of stock debited to revaluation account or say profit and loss adjustment account. Outstanding bank overdraft interest. Increase in liability is a loss, profit and loss adjustment account debit to outstanding interest account credit. Here bank overdraft 45,000, outstanding interest also appears as liability on the liability side of balance sheet, and 5,000 is debited to profit and loss adjustment account. Creditors 2,000 not payable, creditors are 20,000. Decline in liability gain, creditors account debit to profit and loss adjustment account credit. Creditors account debit to profit and loss adjustment account credit. So from 20,000, 2,000 deducted, 18,000 is the reported liability, and decline in value of liability is again revaluation account is credited. Now all revaluation adjustments are over. I want to consider the remaining details from the balance sheet. That is known as copy the balance sheet. Cash balance brought forward. Outstanding income appears on the balance sheet liability asset side. Capital of Ramesh credited to Ramesh capital account on the credit side, balance brought forward. That of Naresh 55,000. Now after considering all these things, I want to close profit and loss adjustment account. Total of credit side is 22,000 minus 13,200. We get a profit. That profit will be distributed in the profit sharing ratio that is equal. So 4,400 is the distributed profit. Profit and loss adjustment account debit to partners capital account credit. So Ramesh capital account, Naresh capital account credit, profit and loss adjustment account debit 8,800. And this revaluation profit credited to partners capital account. Now the value of goodwill determined 40,000. As I told you, book value is 0. Valuation made 40,000. Increase in value of asset known as goodwill 40,000. That increase will be distributed amongst old partners in the old ratio. Look at the accounting thereof. See, here the goodwill is raised and shown its full value. The obvious reason is new partner does not bring a specific amount for goodwill, though he has acquired a share in profit. He is not giving goodwill value. He is not bringing an earmarked specific goodwill at the time of admission, and in such situation, the goodwill is raised and reported in the balance sheet. So here goodwill 40,000, book value nil 40,000 increase, distributed equally amongst partners. So goodwill will appear in the balance sheet. Goodwill account debit to Ramesh capital account 20,000, to Naresh capital account debit 20,000. So goodwill appears in the balance sheet at 40,000 and capital accounts are credited with 20,000, 20,000 each. This is how accounting for goodwill is made. Now capital brought is 25,000. Entry for that, cash account debit to Pankaj capital account. Here cash account debit, Pankaj capital account credit. Now after writing this capital and goodwill entry, now we want to close this books or close the accounts. Okay. Now for that, I start with capital accounts. Total of Ramesh 55 plus 20 plus 4,500, 4,400, 74,400. This is the closing balance that will appear on the balance sheet liability side. For Naresh 55 plus 20, 75, 79,400. His capital is also 79,400. New partner Pankaj brought 25,000. So his capital balance will appear at 25,000. This is how capital balances are reported in the balance sheet. Now I want to close this cash and bank account. 10 plus 25, 35. Closing balance 35. That appears on the balance sheet asset side. Now all the accounts are closed and reported in the balance sheet. Now at last, I want to tell the balance sheet. Have the total of balance sheet, total of asset side, 120 plus 40 plus 19,800, 32,000 plus 35,000 plus 5,000, 2,51,800. Liability total is also 2,51,800. This is how this sum gets solved. I think you must have followed this sum. Thanks to all of you.